Everyone is obsessed with the Magnificent Seven, but what if the best long-term returns come from stocks that no one's hyping yet? What if they come from the boring stocks that you may avoid? I've picked 7 companies, my own personal Magnificent Seven, that I believe have better upside potential. And when I bought them, they were selling at prices below their value. Let me show why I chose them and why I think they will beat the market and the Magnificent Seven over the next decade. So let me tell you why I created my own version of the Magnificent Seven. Right now, the S&P 500 is more top-heavy than ever. That means the most expensive, most valuable companies are at the very top and really driving the returns. Those 7 companies are Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. Guys, they make up over 35% of the market cap of the S&P 500, while only making up 1.4% of the companies. That's dangerous. Why? Because most of these stocks are priced for future perfection. Don't get me wrong, these are phenomenal businesses, but the expectations built into their prices leave very little room for error. And in investing, like most things in life, when you don't allow for error, you're going to have a problem. So I built my own Magnificent Seven to compete directly against them. And I not only to compete this year, but I wanted to show over long periods of time how these 7 boring stocks would compete for a long period of time. Several years, upwards of a decade. And guys, another thing that's absolutely crazy, there's even talk now of replacing Tesla in the Magnificent Seven with either Oracle or Broadcom. Why? Because Tesla stock price isn't going up fast enough, and Oracle and Broadcom are absolutely soaring. That is stupid. That's exactly why we teach what we teach. That is focusing on price and not on fundamentals. Now, each of the stocks I picked are based on valuation, fundamentals, and long-term potential being priced the right way, not hype. And unlike the market's Magnificent Seven, I only buy them when the price makes sense. That is what principle-driven investing is about. It's about understanding that in the short run, the voting machine is going to decide which stocks are going to go up and down. But in the long run, if I pay a reasonable price, the weighing machine will carry me to gains. In this video, I'm going to walk you through exactly why I picked each stock, how I value them, and the price I'd pay for my biggest opportunity right now. These are real companies with real profits and room to potentially grow. But most importantly, it's where price, I believe, was below value to start the year. So let's take a look at them right now. So guys, this is the first quarter. If you remember, the market had a little bit of a plunge in the first quarter. My stocks, Paul's Magnificent Seven, up 1%, the S&P down 4.27%, and the actual Magnificent Seven down 15.67%. So I came out guns a-blazing. Things were going well for me to start. I was surprised by this. I thought the momentum of the Magnificent Seven would continue on. Quarter 2 showed up. If you remember, the market bottomed on April 8th, which is the very start of Q2, and then skyrocketed from there. Check this out. This is the second quarter. This is the performance. Magnificent Seven up 19%. S&P 500 up 10.5%. My Mag 7 up 5.62%. So through the first half of the year, even though the second quarter was a big quarter for the Mag 7, I was still outperforming the Magnificent Seven and the S&P 500. But guess what? That voting machine did not stop in the third quarter. It just kept on going. Look what happened in the third quarter. Another big quarter for the Mag 7, up 17.9%, S&P up 8.24%, and a measly 2% from my boring stocks. That's the way it goes. Guess how much I worried about it? Absolutely zero. And here's where it is year to date from January 1st till September 30th of 2025. I'm currently up 10.5%. S&P is up 14.8%. Magnificent Seven up 18.4%. Look at this rebound. And guys, it makes perfect sense. It makes absolutely perfect sense. When stocks go down, the overhyped ones are going to fall the hardest, like we saw in the first quarter. But when they rebound, the hyped ones are going to go rebound right along with it. This is something we see in every bull market, and I'm okay with that. Remember, I'm going to keep showing you guys quarter-to-quarter updates. It's really important to me to put my money where my mouth is. And I own every stock in my personal Magnificent Seven. But remember, you're not to buy a stock just because somebody on the internet does that. Even Warren Buffett, don't buy it for him. We're here to teach a process. We're here to appeal to people who are trying to learn how to fish. That is super important. If you're just trying to get somebody to hand you a fish to buy, you're not going to do very well in investing. because you have to understand why you're buying something so that when it's time to sell, you understand why you're trying to sell it. So what are my Magnificent Seven stocks? Nike, Alibaba, Ulta Beauty, Southwest, Sprouts Farmers Market, PayPal, and Adobe. And actually, in full disclosure, I no longer own Sprouts Farmers Market. I lost it to covered calls at 165. But here's what's interesting. I got a little lucky there, guys, because look at Sprouts now. Sprouts Farmers Market is actually down to $108 per share. So even after paying my tax, I bought it 31 to 33, wrote it up to 165. Even after paying my tax, my base, I ended up netting 125 a share. So if I were to buy today, I would still be ahead of that. Complete dumb luck. It could have gone way higher from there. I'm not the person who's going to take credit for short-term gyrations in the market. Just like if it went down, I wouldn't blame myself for that. Now, guys, these Mag 7 stocks are incredible. Amazon, you buy everything from there. Tesla changed the world of electric vehicles. It's absolutely incredible. These are two companies that actually have kind of struggled for stock gains in the last 4 or 5 years, probably because they shot up so much so fast. And then, of course, you have Elon Musk, who's gotten a little controversial because of his political views and buying Twitter and converting it to X. NVIDIA, guys, NVIDIA is incredible. This company's absolutely skyrocketed. And not only has their price skyrocketed, their value has skyrocketed. If you're on the AI train, this is the company you have to at least consider whether, even if it's overvalued, you have to at least look at it and say, what's the real value here? The downside for NVIDIA is, well, it's shot up a lot in revenue and profit. Is that sustainable? That's the real question. Meta was a company I owned. I started buying it all the way down to $88 a share on November 4th, 2022. I got lucky enough to buy the absolute bottom. Don't get me wrong, along with buying it all the way down. But now it's skyrocketed back up. Just like Sprouts, I lost it to covered calls, and I regret every second of that. Major lesson learned there, but an incredible company, incredible balance sheet, incredible growth potential for profit. Microsoft, I think one of the best companies out there in the world. 70, 80% gross profit margins, everywhere you want to be, cloud computing, software, everything you want or need. Google, guys, they own the two biggest search engines in the world, Google.com and this very website you're on right now, YouTube. Absolutely incredible. Google is leaps and bounds ahead of everybody in terms of search. Nobody uses any of those search engines. If you do, you probably use them by accident because some software provider like Microsoft forces you to go to Bing. And of course, guys, there's Apple. Apple is the tried and true blue chip of tech. This company releases a phone and people clamor all over to buy it. It's absolutely incredible. This company's here and they're ingraining all of Apple into our lives. And 10, 12 years ago, when smartphones were still relatively new, Apple was selling for very reasonable multiples. And my biggest concern was, well, what happens if somebody comes around and just makes a better phone? What's going to happen? Well, now they're pretty much just locked in at being the number one provider. Now, my Magnificent Seven. We already heard that. We talk about each one. Southwest, I'll get into in just 2 seconds in a more thorough analysis. Adobe. Second best software business out there. Great subscription, great margins, 89%, still growing. I think AI will benefit Adobe significantly, and the stock is down big time from its all-time highs. Not a reason to buy it in and of itself, but it's a reason to pay attention. Sprouts Farmers Market, even though I don't own it, it's a company that it's in a tough business, but they're creating high margins, increasing those margins, very, very specific niche market they're trying to be in. They have 400, 500 stores. They can go to 12 or 1,500 on the current platform they're using. This company has a lot of potential and they're doing a great job executing on every front. They have smart size stores. Nike, guys, this is the leader in sports apparel. I just look at this as this company's gonna be around for a very, very long time, and it's down from an all-time high of 180, got as low as in the low 50s. You gotta take a look when a company like that is down 60, 70%. It doesn't mean it's a good value, but you gotta take a look. Alibaba, everybody was anti-China for the longest time. China's awful, China's terrible. And I look at it going, China loves money. They love their middle class growing and becoming rich, and their rich love being richer. Yeah, they're communists, but I just look at it going 20, 30 years down the road, will China be more free and wealthier than it is today? Yes, I think they will be. So the question becomes, is Alibaba going to benefit from that? Yes, they will. So can I pay a reasonable price for Alibaba? Well, Alibaba is the biggest gainer out of all these companies this year. It is up huge. So that has changed whether it's a good investment or not. We will take a look at that at some point. PayPal. PayPal is up there with Venmo and trust. People trust PayPal. They're very pro-consumer, they're all about safety, and they're what's used worldwide. You want to ship things. And on top of that, the stock is down from an all-time high of 310, also got as low as $50 a share. It's meandering up and down, but it's a company that I think you got to pay attention to because everybody says they're dead, but their revenue per user, their profit per user keeps increasing, and they're doing a better job of getting more profit from each user and focusing on that. Ulta Beauty. So Ulta has that retail component to it, but guys, this is a company that does a great job in retail. They have great margins. Women love going to the stores. The stores are great. The stores are beautiful. People will still shop. And I think a company like Ulta that's still growing profitably, but also buying back shares intelligently makes this the company to watch for the long run. Now, Southwest. Southwest is the company that I'm going to talk about because I think it has the most potential out of all these. It has been meandering about, even during COVID, it got as low as $25 a share or so. It's at $32 a share, but here's my play on Southwest Airlines. Their margin is a 1.43% last year. The last 5 years was 0.4%. Before COVID, they were between 10 and 15% like clockwork. That's my thesis, that this is a well-run airline. Yes, it's still an airline, but it's a well-run airline that I think will get back to its normal level. Now, guys, we have 8 pillars. This is useless for a company like Southwest. Why? Because they look bad backwards looking. It's the future that looks really good for Southwest. This is a company that if they can just get to 8 or 9% profit margin, the stock is worth a ton of money, which we'll get into in 2 seconds. Now, I've gone over a lot here. And if you're new to investing or new to the channel, I want you to know that it can feel overwhelming, but it's okay. I learned this all on my own, and it took many years. You have the benefit of the internet. You have the benefit of YouTube. I assure you that if you're the kind of person who likes to ask the question why and understand why you're doing things, this is the channel for you. We're here to ask the question why. NVIDIA's a great stock. Why? NVIDIA's good. Why? If you're always asking why, you're asking the right question. You're not alone in being a little confused here. And if you're more advanced, it's great. I love hearing things as advanced as I may feel I am with investing. I like keeping things as simple as possible. Now, if you're a new viewer, there's a lot of metrics here I talk about. Do me a favor. I created a cheat sheet for you. I wanted to teach on YouTube so I could make things simple for more people on something that I thought was often overlooked, and that's money and investing. So I created this cheat sheet for you to go over all these metrics so that as we go along in these videos, as you watch more of them, we're speaking the same language. And this cheat sheet, this PDF, is absolutely free. Just click the link below. We will email it to you within a couple of minutes. That way you have these at your fingertips, that whenever you hear some sort of metric you don't know, you look it up. And more importantly, now when you're talking to your friends about investing, you can sit there and pull up things like, I don't really like their price to sales ratio, or, have you noticed their return on capital is kind of low? You're going to be the smartest guy in the room. Now remember, no matter whether you're new or more advanced, most investors, you have to understand, lose money because they're trying to pick winners. The best investors do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a company. We're looking at the company saying, why would this be a bad investment? Now you might sit there and say it's a negative way to look at things. I don't. I look at it as, can this company survive? What are the reasons why this wouldn't work? And if the company's going to be around for a long time, how much money can I make from it? Now I'm going to go through the stock analyzer tool for what price to pay for Southwest. But before we get there, on our software, we also have our analyst estimates. And analysts think that this company is going to start making $6.66 here in a few years, up from $1 a share this year. That's some big growth. At 20 times earnings, that's $130 stock here in 4 or 5 years. It's currently at $33. That's 4x potentially if analysts are right. But I think they see the same story that I see, that it's a margin game, because that's the only way you get this kind of growth in profit when your revenue growth is only 2 to 6%. You don't get that from huge margins in this business. You get it from the margins coming back up. That's what's huge. So now we have this story, we have the numbers, and that's when the stock analyzer tool comes into effect. What you're doing here is you're sitting there and you're making assumptions about the future. Because every time you make an investment, you're going to get some sort of cash flow in the future. The question is, what's that cash flow worth to you? That's what this does for you. It allows you to make all these assumptions about the future for the next anywhere between 1 and 20 years. I always pick 10 usually. And you sit there and say, hey, if the company grew like this, had this profit, sold at this PE, and I wanted to make X return, what should I pay today? That's simple. But this is a great point to sit there and say, should I even spend more time? So let's pull up my assumptions on Southwest here. And there's a reason why this software, this stock analyzer, is used over 1 million times per year by our users. So first off, revenue growth. I did 2%, 4%, and 6% for the next 10 years. Nothing crazy, very reasonable. Profit margin, 8, 11, 14. Guys, they had years where they were doing 15% before COVID. I had my highest year at 14. So I'm not even going crazy here. PE. Now, what's the PE and price of free cash flow for this company in the future? Well, guys, here's what I'll say. In the last 5 years, they've had negative return on capital, and 10 years, 7.2. So if you take out COVID, they've done 14 to 15% returns on capital. Now you're probably like, what the hell does that mean? You'll read about it in the PDF, but just a quick idea is the higher the return on capital, the better the business is. Not many airlines have those kind of returns on capital. This is the best run airline in my opinion. So this company deserves a premium. I still did put 14 on the low side, even though historical average is 15 or 16 for the PE, but I put 17 and 20 here on middle and high. Could I see you going higher? Sure, it's a very well-run airline. This airline didn't lose money until COVID, had 48 years in a row of profitability, when pretty much every airline at some point had declared bankruptcy. They never had. They focus on the same plane and very efficient and highly profitable routes. Now, believe it or not, 25 years ago, I was the kind of person who was chasing hot stocks, following tips, getting caught in the hype, hoping that something would stick. But then I realized very quickly, that's not investing, that's gambling. Eventually the party ended. And that's why, fast forward many years, I remember thinking to myself, I want to teach people how to invest in a way that I was never taught. That's why Everything Money was created. It was giving 15, 20-year-old Paul the tools, the strategy, and the community that I never had. So when you join Everything Money, you're not just getting our powerful investing software and obviously this very world-famous stock analyzer tool. You're getting a foundation of thinking about money. We integrate you in the community. We have free courses on our software that teach you so that we all speak the same language, so that when you're engaging in the community of like-minded investors, you're speaking the same way they are. Because guys, everybody there is trying to level up their investing just like you. But it takes that community to do that. So if you're committed to investing the right way, if you're committed to being a learner, start your 7-day trial today. Click the link below. We have limited spots, but if you're serious, and that's super important, if you're serious about getting better and increasing your investing game, join. If you're not, stay away. We have no desire to have the opposite kind of person in there. So I hit the analyze button on Southwest. Click below. This is why I'm interested in this company. I have a low price of 55, high price of 160, middle price of 100. Huge potential returns if they can run the numbers above. Even if they hit the low numbers, I'm still going to make potentially 18% return on my money based on today. Now, it's not set in stone, but if I had 30 companies that had these numbers on them, I'm probably going to do pretty well. Now, let me share something else that's really important with you. I think there's going to be a great future stock investing opportunity. It's super important that you get this knowledge of principle-driven investing and the skill to value stocks before the market turns. In this next video, I'm going to show you how we do it so that you're prepared to act when opportunity arrives, because it will arrive. The video is linked right on your screen, so don't miss it. And this is how you put yourself in the best position to potentially get market-beating returns. But more importantly, to sleep better at night when everyone else is scared shitless. Thank you for your time.